major investment for Uber. SoftBank reportedly nearing a deal to take a substantial stake in the ride-hailing company, but only if it can persuade shareholders to sell enough stock at a steep discount. They want a 30% discount. The Wall Street Journal says that the potential investment could be $10 billion. Plus, Alphabet also reportedly considering a billion-dollar investment in Uber rival Lyft. The deal is perhaps the latest sign of strength in the private market. Joining me right now, a kingpin in that market, Carlyle Group President and Chief Operating Officer Glenn Youngkin is with us. Glenn, good to see you.
Good morning. How are you?
Thank you so much for joining us. Obviously, Carlyle is one of the most successful outfits out there. Your take on this story this morning in terms of SoftBank with its huge $100 billion technology vision fund wanting to put some of that money in Uber?
Yeah, I think it just represents the strength of the private capital markets. We have this ecosystem which has developed really over the last 10 to 15 years, which is a private market where a company like Uber can actually prevail and achieve and garner capital for its whole lifetime. It's really different than what it used to be, Maria. Maria, used to a company would have to go public. They would go public early in their life cycle, and that growth would actually be realized in a public setting. Today, it's not like that at all. One of the great realities is the Wilshire 5000 only has 3,700 companies in it. And the
yeah, you're right. That's
is,
funny.
There's just a lot fewer companies that are public today. They're staying private.
That? Glenn, is that because the bureaucracies around going public? It's not the experience that these companies want.
Yeah. So, well, just this morning, Uber has a chance to actually access $10 billion, speaking with one investor. They don't have to file with the SEC. They don't have to go through that whole process. They don't have to report every quarter. And as a result, the ability to actually grow a business aggressively, not be held to quarter-by-quarter standards, is really interesting for companies in a private setting.
This is such a good point. How do you capitalize on that at Carlyle? Tell me how you're allocating capital in the private market.
So what's been most interesting is that the investor base in private equity has really realized this. And so allocations were for most of our large investors, from sovereign wealth funds to state pension plans, all the way through to high net worth individuals, have really been shifting towards private equity. Now, the returns have been really good for a long time.
Exactly.
A 1 year, 3 year, 5 year, 10 year basis, the returns in private equity have been better than public alternatives. But the reality is they know that they can hold these companies for a lot longer today and actually compound those returns. So it just makes this investment environment pretty interesting for private capital.
Tell me where you see private capital going. Where are the opportunities? Can you name sectors? I know you've been, obviously, energy has been very important to Carlyle over the years. Give us that standpoint.
Yeah, well, first and foremost, given the reasonably slow growth but consistent growing economic environment, and the expectations, even despite the UK central bank saying they're going to raise interest rates today, interest rates are expected to stay low for a long time. So as a result, we think asset values are high today, and they're going to stay high today. So there really aren't any real big macro themes, other than there are a few high-growth areas like healthcare and technology-enabled businesses. There are some areas that have been beaten down, like energy, which we think is really interesting. Yeah. But the key is, in fact, in private capital, you get to buy a business, develop a business plan, and then really execute against it and drive performance. One of the interesting statistics over the first 6 months of the year is we've seen in our portfolio 10% revenue growth and 10% earnings growth. Now, that is an extraordinary annualized number relative to what's happening in a 2 to 3% growing GDP environment.
That's a nice backdrop, 10% earnings and revenue growth. Does that change, and is it dependent on policy out of Washington? So we've got Republican Party leadership promising a detailed reform in a matter of days. September 25th is when we're expecting the House tax reform plan to come out. The president obviously has been meeting with Democrats, trying to lure them in to get something done. Do you think something happens, and is that going to affect valuations?
Yeah, so first and foremost, what happened over the course of the last year is pretty incredible. Had we been here a year ago, we would have been talking about the expectation that there's a pending recession coming. The economy was kind of stagnant, and we did expect things to really move into a recession over the intermediate period of time. It's quite different today. What's happened with Washington is the expectation there's going to be bad policy that's going to hurt business is actually abated materially. And in fact, if we can get business favorable policies and regulatory decisions out of Washington, it will only help. And so we don't need regulatory policy or legislation to, in fact, make things better, because it's actually quite good right now. I think we're seeing good, steady growth in the United States and around the world. But we're really hopeful that the president and Congress are able to come up, particularly with some tax reform. I think it'd be great for business.
This morning, J.P. Morgan is out with a note basically saying, look, as the headlines keep showing traction on this, investors are going to expect it. The expectations will come up. And they think that if the corporate rate goes from 35% to 25%, that will move the S&P 500 earnings by $10. That's a 150-point rally on the S&P. So what I'm asking you, it sounds like it's just gravy if we were to get tax policy out of Washington, but you're really looking at a backdrop that is quite strong.
Yeah, we are. And I wouldn't exactly say it's just gravy,
right,
Maria. I would say that we hope it will happen, and it needs to happen. I do think the competitiveness of U.S. industry would be materially improved with this kind of favorable tax policy. And that's important as we compete around the world for people and technology and to grow our businesses here in the United States. So we're hopeful that will happen. Listen, Washington is pretty contentious right now. In fact, the one area, Maria, where we think there is bipartisan support is in infrastructure. Today. And tax policy's got all the headlines. And people on both sides of the aisle want changes into tax policy, and we sure hope it happens. Well, we'll say the one place where they agree we need changes, and in fact there's not that much gap between them, is on this infrastructure infrastructure effort that the president has called for.
Yeah, but I think that you really need to see tax reform in order to see people's expectations come to fruition. I mean, let me ask you before you go, in terms of regions around the world, do you like Europe right now? What's your take in terms of the U.S. versus international? Yeah, so
right now we see a synchronized growth around the world from an economic standpoint. So the United States, which grew 1.5% last year, we think is growing at 2 to 2.5% now. Europe is actually growing as fast, if not slightly faster than the United States. We see actual 6% growth in China.
Wow.
Actual 6% growth in China.
But do you want to put money in China, given everything that's going on? You've got North Korea, you've got the U.S. trying to get tough with China.
Yeah, I don't think there's anything particular to China about what's happening in North Korea right now. I think the North Korean aggression actually impacts all of us, and I am hopeful that we'll be able to bring some sort of sanity to that whole circumstance. But with China, interestingly, we just bought McDonald's China and Hong Kong from McDonald's. We bought it in partnership with a large Chinese investment company, and it just represents the fact that we still see huge growth in China, an opportunity to take a business that's good and make it great.
Great. Glenn, great to have you on the program today. Thank you so much.